Seems like the inflation data that we got last week didn't quite move the market or move the needle last week. And then you see bond markets yields are picking up a little bit, but we're still within this tight range in treasuries. Do you see a bit of complacency leading up to this Fed meeting?
Right now, we do agree that inflation remains to be a risk that we continue to monitor, especially because supply chain bottlenecks and also the difficulty in actually finding appropriately skilled labor will likely continue to drive the cost of business going forward. Right now, people or the market might continue to treat this all as transitory, and so it might be a bit complacent. But then if the consumers and businesses start adjusting expectations, this might become more persistent inflation. So that's why we continue to highlight to investors and clients that we need to pay attention to the Fed meeting. Like you said, Yvonne, just now, how brushing inflation worries aside will no longer convince investors. So we'll continue to pay attention to what Fed says about its growth, inflation, and policy rates expectations this week.
So do you think that the reason why we're seeing tech stocks are on the climb again, bond yields, we saw a big rally last week, is this a part of a bit of a FOMO trade, or do you think it's more of a false break?
We think because real yields actually remain quite depressed. So as long as actually 10-year yield remain around 1.5%, those tag and also growth will continue to remain outperform. But then we continue to expect in the medium to long term, the 10-year yields and also the long-term yields continue to move higher. So this will also benefit, for example, fixed income investors who are short duration and also equity investors who have a bias towards value over growth. So this is more like medium term or as the 10-year yields grind higher.
Marcella, that's key, isn't it? Because you do have that bias towards value. You like financials, you like industrials, but with the yields at this level, is any of that calling that into question? You have to have those yields grind higher to continue to favour those sectors.
Yes, indeed. But then right now we see that, for example, like I said just now, investors and businesses are going to treat this as transitory. But then we do see the supply chain bottlenecks. Those are likely to drive the cost higher. And also at the moment, there are also other, for example, portfolio rebalancing that has been happening that triggered investors to be selling stocks and also buying more bonds. But then once we see a potential correction in the equities, we might see balancing towards buying stocks again. And also in terms of yields-wise comparison, international or foreign yields remain low. But then we see that this might also grind higher, for example, with Europe and Japan actually catching up in its progress against the pandemic. And so this may suggest that in the near to midterm, we actually continue to see international yields also continue to grind higher. So this should also benefit. And on the back of that, we also see an improving economic backdrop and more synchronized growth recovery. So this should also continue to shout out for benefit on value over growth, and also potentially more onto those sectors like financials or industrials. They'll continue to benefit from a synchronized global recovery.
Okay, and you're seeing rich opportunities in China. Just talk us through what those opportunities are, and to what extent does China's relative slowness at reopening here and question marks about the efficacy of its vaccine program call some of that opportunity into question?
Actually, with regards to China, the recent RMB appreciation actually convinced investors to refocus back on the fundamentals rather than worried about, for example, foreign exchange rate risk. And yes, like what you said, Tom, we continue to see rich opportunities. In terms of equities-wise, the ongoing economic stability will continue to be boosted by improvement in the vaccine rollout. Yes, there have been questions about the vaccine efficacy, but then we continue to see that as more and more population will be vaccinated, this should hopefully build immunization amongst the population, and this should also benefit the recovery. And so far, we see that vaccine doses are covering around 52% of the total China population. So the progress is actually quite decent. And and also the long-term themes that we've always been talking about, like the focus on structural growth, focus on consumption, technological development, and the recent focus on, for example, policy and carbon emission continue to play out in the long term. So that's why in terms of equity market, and also most important, Chinese market valuation looks attractive once again. So these are like the key catalysts in the near term that we continue to like China.